Hey, welcome back, everybody, to today's Market Explained, a four-star media experience podcast and video series. I'm Brian Castle. I'm your host. I'm back here with my usual co-host, Mr. Chris Reardon. Chris, welcome.
Morning, everyone. Glad to be here and glad to talk a little bit about the markets.
Well, good. So here we are. We're looking to have a discussion about what's happening in the markets. It's a very strange time because there's so many things that are going on that don't make sense. So we're trying to make sense of it. And with me, of course, is Chris. Chris is our director of development at FourStar. He's the master of all things portfolio trading, reports. And he's still a lover of those Cleveland Indians, or are they the Guardians now? Guardians.
The number one in the American League in the Cleveland Guardians.
Very good. And anyway, and Chris has a young family of three. So good for you, Chris, and welcome to the podcast.
Thanks, Brian. Glad to be here.
And I'm Brian Castle, founder and CEO of FourStar. I'm an Eagle Scout, trustee of the National Boy Scout Foundation. I'm an advisor to CEOs and insiders. I'm chief dad to Quinn and Evan, and husband to the amazing Tripty. And I'm proud to be your host today on the show. If you like what you're hearing, please go on Apple iTunes and give us a 5 out of 5 ranking because we try to get as high rankings as we can. The higher rankings we get, the more people that see us. We've been seen on 6 continents, Chris. We're still waiting for someone in Antarctica to watch, although last year we did have a Chicagoan go down there to Antarctica. It was off the coast of Antarctica on a boat, but he did watch the podcast as he got Wi-Fi from the boat about a mile off King George Island in Antarctica. So I would say that qualifies. I think we've been heard on all 7 continents now, Chris. So there you go.
Just didn't ping from the actual continent, but I think it was close enough.
No, but we'll be heading down there in February of next year, so we'll see how that goes. So today we're going to do our standard program of markets, the economy, and then what we see out there. So, Chris, the relationship between all the different asset classes, domestic equities, international commodities, and then our scaredy cat, asset classes like cash, currencies, and fixed income. What does all that look like now? It's been a couple of weeks since we did a show. Give us the
Yeah, so I mean, it's still been, for the most part, a very risk-on environment, with the top 3 being the risk-on asset classes. So number 1 is still domestic equities. It actually lost 5 points from the last podcast we did. So it is pulling back slightly. We've seen kind of some slowing, if you will, in the markets as of late. So we've seen that sputter a little bit. International equities, though, they gained 15 points, or 270 tally points. So still far away from that number 1 position, but it is slowly gaining ground. I think a lot of that movement, that 15-point move, was due to China, who rolled out some different policies that are looking to prop up the market, which we'll talk about a little bit later. And then in the 3rd position, we have commodities. That gained 8 points. Some of that's tied to China and kind of, once again, the policies to shore up some of their markets. But you also have others like gold, oil, things like that have stabilized for the most part. Some of them are still in a pullback as we kind of have rotation within that commodity sector. And then you have the bottom 4, the risk-off asset classes. So cash is in the 4th position at 117, and it's minus 10 from the last podcast. So we continue to see a pullback in these risk-off asset classes, which is really interesting. Currencies is in the number 5 position. It's at 76, and that's minus 4 from the last podcast as well. And then fixed income is still in last, and it's at 66 tally points, minus 3. So, you really have, outside of domestic equities, which is the number 1 that had a little pullback, it was really the top 3, the risk-on class or asset classes gaining, and the risk-off really losing points since the last podcast.
So this is unusual, Chris. I mean, normally we wouldn't see the markets rallying near new highs when we see a slowdown in the economy, which we're going to talk about. And, there's more and more numbers that are slowing down. So but we're still seeing people taking risk right now. Markets topped out about a week and a half ago, and then we've seen a little bit of pullback, a couple of unique names that collapsed and all that. But as of today, the NASDAQ is off its highs by only about 1.5%. The S&P 500 the same way. The Dow Jones is down about 4.8% from its high of about 10 trading days ago. So we're still near highs. Why is that happening? We're not quite sure.
Yeah, I mean, I think it's a lot of it is the mega caps, the fangs, if you will, although, Tesla and stuff have kind of dropped off for the most part, but Nvidia being the latest one, where we're still seeing some companies that are crushing earnings, that they're doing having really strong earnings there. And I still think the biggest component that's propping the market up right now is this anticipation of this AI boom. There is some relevance to that. I think that it is important, just like even cryptocurrencies, Bitcoin, blockchain. I mean, there's elements of it, but I think in some cases there is an anticipation now that's over kind of shooting probably when and where it's going to happen. It might take 5-10 years till we get to where they're anticipating it to be. So I think there's a lot of high level stocks that are pushing the market upwards, where underneath that we're seeing a lot of stocks that are pulling back or just flat.
Yeah. Well, it's usually if the economy is slowing down, then the market is discounting that. But if the market's going up and the economy is slowing down, the market might be anticipating that the slowdown will be short-lived, right? Now, if the slowdown gets worse and worse, then maybe we see that affect the markets. But for now, it seems like the markets are betting. I would say that the bet is this is going to be a lesser slowdown, and the market's already anticipating a trough and then a recovery in the economy for next fall. So the market will discount that in advance, right?
Yeah. Well, and I think the kind of that quick recovery is really based on the Fed lowering interest rates, right? So they're anticipating that the Fed, and that's what you hear. That's a lot driving the market. But let's say the market gets really bad, is the Fed just going to cut in September, or are they going to cut September and December? And
Right.
that's obviously letting some pressure off to let the markets run again. We saw that 2018 when the Fed was slowly raising rates, and then we had a huge crash in Q4. Markets pulling back, the Fed relented and lowered rates back down, and then we saw just the market spring up. It was almost right after Christmas 2018, and markets just shot up after right out of the gate in 2019.
So now officially the Fed is not easing right now, but there are some things going on that are causing easing in the economy. So we'll talk about that in a minute. And then, Chris, just to close the door on market activity, we're seeing consumer staples have been stronger than consumer discretionary. We're seeing a couple of cruise line stocks got beat up badly, and those are the classic consumer discretionary. Now they're giving big discounts to get in Carnival. We saw the other day. They always want to fill the ships, because if the ships are there and full, then you can spend money on the ship. So they'll give away the room just to get you in there to spend money. So that's what the cruise lines are doing, but they're having to give away the rooms basically to fill them. So that's slowing down. So consumer staples are doing better. Financials are doing better, and financials were not doing well last year. And then healthcare stocks, as contrasted with last year, communications and technology were ranked number one. In fact, until November, the markets were flat on the year, and then we saw a big pop rally of about 10% in the broader markets. But then the tech stocks were rallying all year. And so those took the indexes significantly higher. Many investors got confused by that. The S&P was up 24, and then the index on an equal weighted basis, it was up only about 10.8% for 2023. So folks like, oh, I only did 11%, I underperformed. But in fact, if you did 11%, you did what the average stock did. So that's not really a bad return. But to get 24, you'd have to be overly concentrated in these big tech stocks, and what giveth in the market can also taketh away. And we saw some of that in the first quarter, where those tech stocks corrected, and they correct hard and they go down hard. So right now, communications and technology, Chris, are ranked out of 11 S&P groups, 1 through 11. They're ranked 7 and 8. So they're not really doing as well this year. Although in the short run, we've seen a little bit of a rally in NVIDIA. We'll talk about that. So that's what we're seeing right now in the markets. So markets are still strong. Economy is slowing down. Let's dig into that, Chris. We saw April core numbers. We saw durable goods numbers. You got a whole list of them.
Yep. Yeah, so actually the biggest news I would say that we have is the personal consumption expenditures index, which is kind of what the Fed likes to look at, or one of the numbers they like to look at. We got the number for April. It came in at 2.7%, which was pretty much right at the estimates. But month to month, that's still an increase of 0.3%. So, the concerning trend we're seeing there is that increase. Even if it's small, it's still an increase month to month. So, if that continues, obviously we still have a 0.3, which I think the last 3 month-to-month increases have been at 0.3%. We're going to see that creep up to 3% total. Then, where does it go from there? So, it's interesting to note. I think that the key is that that line, kind of that derivative of where that, what's the month-to-month number, not necessarily the annual number. The core CPE or PCE, sorry, was up 2.8%, so a little bit higher, and that was up 3.3% month to month as well. So overall, I mean, and then that's a big impact. Obviously, if inflation continues to reinflate, it's really hard for the Fed to cut. And a lot of what we spoke about there, what the market's anticipating, which is maybe a quick drawdown, and then kind of a pop off the bottom, that can be kind of put to the side. It can be thrown off if inflation remains high. The Fed can't cut rates with a high inflation rate. So that is something key I know to keep an eye on. We also had the Chicago PMI, which is the Purchasing Managers Index. That's kind of all business consumption goods, things like that. For May, that came in at 35.4. Estimates for 41. So a big miss there for the Chicago area. Anything below 50 is contraction. So we are continuing to see contraction in the Chicago area. Not too surprised. I mean, there have been notable companies that have left, Citadel, Boeing, so some major players that are leaving. So not too surprised that we're getting some downward numbers there. Obviously, we're from Chicago. We'd want to see this going back up. What we really need to see is for that number to kind of start to bottom out and slowly start to ease back up. Hopefully we get the right policies and everything in place to assist with that there. But right now it still seems to be moving in the wrong direction.
So,
go ahead, Brian.
Chris, I was going to add, in the last 4 months, January through April, those are numbers that we have. There are 8 major inflation indicators, obviously Consumer Price Index, CPI, and then the Producer Price Index, PPI. And then there's derivatives of that, like you talked about the Chicago PMI and things like that. However, the CPI has been up 3 of the last 4 months. In April, it reversed back down, which is good for the folks who think inflation's going down. The Producer Price Index, however, has been up all 4 months in a row. So we talked about this on previous shows, that in the 1970s, we saw huge inflation based on energy, and inflation was completely out of control. Then by the end of the 70s, 79, inflation had come back down, not all the way down to the 2% Fed target, but close. Then spending ensued, and all of a sudden they ran it back up. And we had another huge run of inflation in 79, 80, 81. In September of 81, it topped out at 16.9% in the Fed funds rate, as they had to keep raising rates sharply to ward off the second round of inflation. So there's big concern that that's what's going to happen again. So like Chris said, all year everyone's been talking about rate cuts, and the economy's slowing down. We have to get rate cuts to get the economy going again. Economy is now finally slowing down, but inflation is not going away. So now we're seeing the inflation. So 7 out of the 8 major indicators in the last 4 months are up. Inflation appears to be coming back. So we'll be very curious to see if it continues in May and into June, because people are still spending. Consumer expenditures have not fallen, like Chris mentioned, right? So it was right in line. So consumers continues to spend at high rates. We're at very high rates of debt as well. So then that makes the case for, will we see not only rate cuts, they were talking about 6 rate cuts at one point, then 3 rate cuts, then maybe later in the year, then maybe in the fall, maybe before the end of the year. Now there's only talk, Chris, of what, November, possibly. Rate
Yeah.
cut.
Yeah, September, November. And I think an important point that you said is that PPI number, which is the producer's price index, is usually a leading indicator because that's, the McDonald's, that's also, if their prices are increasing, they're more likely to pass that on to the consumer. So usually if that is increasing, that's a leading indicator that that CPI number is going to move up as well in subsequent months. So
And we've seen a lot of effects of inflation. And so, maybe inflation is still going to stay here. So, Chris, if that meant that inflation is back, what do they do when inflation is back? We not only not lower rates, we'll raise rates. So
yep.
there are very, very respected strategists saying that the next move in interest rates not only not down, it's possibly up. So we'll see.
I think Jamie Dimon, I think obviously the JP Morgan CEO and one of the most powerful men in America, he came out, I think, and said he could see rates go up to 6% or higher. So I think it's the realization is starting to come back. There was that hopefulness, but I think we're starting to see more and more people come around and either discount to no rate cuts or even say, hey, there is the potential now that we could see rates go higher.
Yes.
So kind of going back to kind of what you were talking about, April core capital goods orders, which is kind of consumer or business spending, what they're purchasing, machinery, things like that. That increased 0.3%. So that's nice, modest improvement in business spending. And durable goods orders were up 0.7%. So that kind of points to what you were talking about, Brian, which is the consumer and businesses still continue to spend right now. We haven't seen that drop off yet. Albeit, as you said, there is debt that is rising. There are certain concerns, but that kind of power, that engine behind the American economy is still there, which I think is helping right now kind of blunt some of the offsets we're seeing.
Yeah.
In the real estate market, sales of previously owned homes decreased 1.9% from the previous month. So that was March to April. We had a decrease of 1.9%. That was the largest monthly decline in over a year that we saw. So we continue to see the real estate market struggle with this. The reason we saw that bump there is because for a little bit, mortgage rates kind of decreased slightly with the anticipation of those Fed rate cuts. And as those started getting priced out of the market, we saw those rates go back up, bump back up. So we are seeing that impact the real estate market. That continues to be a concern. We have all-time highs really still on the home real estate front. And it's just there's really a struggle there as far as transactions and being able to purchase. So and then the last little note I have kind of leads to that. Being able to, with all this inflation, being able to kind of afford a living. They did a survey of parents living with children under the age of 18. And in 2023, 64% of parents said that they were doing all right financially. And that was down from 69% in 2022. So it's a pretty big pullback. That's a 5% pullback of people that at one point in 2022 said they were doing all right, now aren't. And the broader response, so just the whole US, 72% of the respondents said they were doing all right in 2023. That was only down 1% from 73% in 2022. So, as you said, Brian, I mean, inflation isn't necessarily, it's like if it's down, it's a down across the board. We still have very high inflation on daycare. Even rents are coming down, but they're still, staying somewhat elevated. You have home prices, you have, food, restaurants, all that. So it's not, there are portions that are coming down, but it's impacting certain areas and certain different demographics more than others for sure.
Yes. Well, and Chris, that inflation has caused, we have deflation, right? So to correct inflation, you see prices come down. That would be deflation. We haven't seen any of that. We're still trying to get rid of the inflation. So the inflation that's caused food prices, energy prices to go up 20 and 30% over the last 3 years is still in place, right? So people keep going to the store and they see things. The restaurant industry has been particularly hurt because it's really hard to pass on all those food cost increases. So we had Red Lobster announce that they're going bankrupt and they're not going to reorganize. They're going to liquidate their company. Now, somebody might buy those restaurant locations, maybe in a package. They may buy them, onesie, twosie here and there, and they'll sell off to other things because they do have buildings and restaurants and everything. But basically, Red Lobster is done. Cracker Barrel also, and that was a big name in the 80s. Cracker Barrel has done pretty well, but they've lost, they've closed some restaurants. They've lost about 14% growth recently. They're lowering their dividends. So some of the old restaurants, and that may be just generational, that maybe there's some new ideas, new restaurant concepts that need to change. But a lot of the older restaurants are not doing as well. They got caught by inflation. Even McDonald's, for the cost of a burger Happy Meal was $6. It's up to about $12 now. It's almost doubled in price in the last 3 years. So it's pretty striking. Walmart is closing stores, Chris, selling off inventory. And then the consumer is slowing. So VF Corp, which is the name for actually originally Vanity Fair Corp, and now they call it VF Corp. They have a consolidator of clothing brands from Levi's to everything else, and they sell tons and tons of jeans and shirts and clothes and blouses and tops and everything else. They had really bad earnings, so people slowed down in apparel as well, Chris. So that's all from the inflation, and that's really an issue, and that part of that's slowing down the economy.
Yeah. I mean, I think it's hard for people to conceptualize, but one of the things that I'm glad you said, Brian, but what we've seen now is just a slowing of the inflation. So in certain cases we've seen the deflation, I think in the car markets here and there, used car markets, but for the most part, prices are just going up. So we're not seeing grocery bills aren't going down. They might be going up less quickly. So people are kind of get confused, I think, because they think, oh, all right, if inflation's tame now, that means that things should be getting back to normal. It's not the case. I mean, things are still going to be just as expensive. They're just going to be increasing at a less higher rate. So I think people sometimes confuse that. And the last point I'll say is, with having three little ones, I can personally attest that McDonald's is getting much more expensive. 3 Happy Meals, I think, costs like $35 now. It's almost like you go to McDonald's and it used to be what you could, go to another restaurant, just a regular restaurant, and pay for a lunch or a dinner. So it's pretty crazy.
It is. Well, so all this inflation and slowdown in the economy is causing lots of issues, and so now we're coming into election season. President Biden is most likely going to be renominated, but there's also some talk that he might not. And we're taping this the day after the big verdict. President Trump was found guilty of 34 felonious accounts, although many think that those counts were fake. It was a books and records case that they turned their misdemeanor turned into a felony. So now there's a battle going on either way. So that's all kind of politics, and we'll see what happens there as we get into the summer. But just looking at the economy, we're in election season, and what would the two candidates do, assuming that former President Trump, makes it all the way to the nomination, and assuming that President Biden makes it all the way to the nomination? There's talk that neither one of them might be the candidate for various reasons. But let's just look at it. President Biden has had a very bad economic record, and his economic advisor, Lael Brainerd, who used to be a Fed governor, announced tax plans. They say they're not going to raise tax on folks under 400,000, and that's what they're trying to do, income. So everybody will get a little tax break, but not much, not enough to move the needle. But they're putting a stock buybacks tax, so 1 to 4%, to encourage companies to invest in workers and pay dividends and not buy stock back. But actually, a stock buyback is just like a dividend. So people are using politics on that one and not really understanding finance, because buying stock back is very good for shareholders also. So anyway, the whole statement is really pure politics, demonizing the wealthy and putting the government finger on the scale for corporations, not understanding the impact of stock buybacks. President Trump had tax cuts for workers and families, and now they're talking about using those tax cuts to let them expire. So the top 5% doesn't, they don't get their tax breaks anymore, but they'll leave that they're talking about tax cuts for everybody but the top 5%. So it would be really bizarre if they did that. 95% of households make less than 400,000. So this is really targeting the wealthy. The top 5% right now pay 75% of all US taxes. So, they always say something like pay your fair share, but at what point is tax policy fair? I mean, do the top 5% have to pay all the taxes? Right now they're at 75%. It's a great majority of the taxes. So that's an issue that's never defined, and it's really more surrounding politics. So here's the contrast. Biden is attempting to raise taxes more, higher corporate tax rate, new rules for multinational corporations to yield more tax out of them. And they're also talking about a very, very toxic idea of raising taxes on unrealized gains. Now, functionally, how they would do that would be very tough. But if you own shares of stock or you own a piece of real estate and the value goes up, they want to tax you on the value before you actually get it. So you wouldn't have the cash flow, but you'd have to pay the taxes. And so that would be really, really toxic to the economy. Trump's program, on the other hand, would be to lower taxes again. So by generating more revenue and lowering taxes, you can do that. And then obviously that's good for the economy and that'll get job growth going. So during the Trump presidency, before the Biden presidency, we had a really good economic run. We've not had a good economic run under the Biden administration. And now they're proposing even more taxes and it would hurt the economy. So on balance, we would have to say we're not talking about politics necessarily. We're talking just purely about policy that President Trump's ideas would make the economy better. Now, you may have other opinions and reasons why you might like the other proposals, but just on pure economy, President Trump's programs would offer prosperity for all. And one big important thing that President Trump had talked about is paying down debt. We now have 34 trillion in debt, and it's getting to an existential point. There's coming a point now where the cost of that debt is going to be crowding out other spending in a massive way now that rates are higher. So we have to really worry about all those issues going forward. We need to pay down debt. That would be a smart proposal. President Trump has suggested he would do that if he gets back in office. Have not heard from the Biden administration about that, but the debt is becoming a big problem. So that's kind of our take on the presidential election, just on an economic basis, and not talking about this party or that party, just which candidates' proposals make more sense. Chris, what do we see out there? Anything else interesting?
Yeah, well, one hindsight I think would be interesting if they did do a tax on the unrealized capital gains would be what about like a year like 08, 09? If everyone had a giant loss, would the federal income be like nothing because would they tax that? And there's so many different outlooks with that. So I just find that it sounds good on the front of it, but it's I don't know. It just seems but yeah, so what we see out there, international markets, I'll touch on real quick, even though we had a lot going on in the US. Japan's consumer prices rose 2.5% from a year earlier in April, compared to a 2.7% increase in March. So that's good. We're seeing a little bit of a decrease there, but still, at that above 2% level. The big news we talked about in the beginning, Beijing rolled out a series of policies aimed at shoring up their real estate market and the economy. The centerpiece of which would have city and local authorities buy unsold homes and convert them into low-income housing. So, China had this big issue. They just built and built and built, and there's a lot of properties and real estate that is unused there. So they're looking for a way to get that and then pass that on to, whether it's low-income housing. They also scrapped minimum interest rates on mortgages and reduced the down payment. So off of this news, we saw a big pop in them, about 20% pop in the real estate markets, stocks. That has since come back a little bit. I think that have they done enough? How much is this really going to stick? And does this really have the potential to turn them around? That remains to be seen, but I think we're seeing some skepticism as kind of the weeks have gone on now. The Chinese Consumer Price Index rose for the third straight month in April to 0.3%. compared to a year earlier. So we're continue to see, the issue that China is running into is actually more closer to getting to a deflationary level. And if that happens, deflation itself is actually worse than inflation, and it's harder to combat. So, they definitely do have some issues. And then Canada came out, their inflation was up 2.7% in April, which is actually the slowest pace in 3 years. So, Canada seems to be doing a little bit better on the inflation front than some of the other economies closer to them. A couple other notes: oil prices have remained relatively muted on concerns that lingering high inflation could curb fuel demand. We're entering the summer months now, so that's usually when you see gas prices go up. You have people traveling, driving everywhere. We have continued to see that muted. Although we recently had the Iran's president who passed away in a helicopter crash, which is very interesting. And for those of you who are unfamiliar with Iran, the president isn't kind of the head of the government, and there it's actually the supreme leader. But the issue that puts Iran in is the president there was seen as the likely successor to the supreme leader, who is, I think, 72. He's getting up there, maybe even older than that, actually. So that kind of puts this power vacuum in place in Iran. So that could have an impact. The reason I say that is that could have an impact on oil prices. Iran itself has obviously been much more volatile. We've had the Israeli situation. And then, more and more information keeps coming out now that, they're potentially months, if not a year away from being able to produce a nuclear weapon, which, when you look at their network of proxy groups, Hamas, the Houthis, all these different groups, terrorist organizations, it becomes really scary. Would they arm these militant groups and try to attack Israel with a nuclear weapon, things like that? So, what does that do with the markets? It just creates more volatility, which usually tends to push the price of oil up. And then the gold bullion actually hit the lowest price since May 9th. A lot of that was due to what we talked about, this anticipation of rate cuts being pushed back. Now I think they're only pricing in one this year. So that's having a direct impact on in the short term on gold prices. And then the last thing I'll note, NVIDIA, which we kind of touched on a little bit, but they had earnings last week and they crushed earnings, which caused them to surge on the week over 15%, with the stock going over $1,000 a share. They announced a 10-for-1 stock split. I believe that's supposed to take place next week, the first week of June. But it was a huge earnings. Their data center category rose 420% from a year earlier. So NVIDIA continues to be kind of a bright spot within the market. But one interesting tidbit I found is last week alone, NVIDIA's market cap increased just last week. And the move it had more than Salesforce, more than Oracle, more than Adobe, more than the entire market cap of several very large and obviously prominent tech companies. So the big keeps getting bigger. And I think NVIDIA is at this point really pushing Apple for the most valuable company in the world. So if it continues, we could see that overtake Apple.
And the 10-for-1 stock split as well.
Yeah, the 10-for-1 stock split supposed to take place next week. NVIDIA, for the most part, this week, obviously after a big move, you would almost expect kind of a consolidation, but it's actually held those gains this week, if not gained a little bit more. And usually, it's not always, when we have a stock split like that, you actually do see usually a pop off of that just because the price gets decreased for the general investor. Once again, that's just kind of usual. So we might not see that. We might, but we could see NVIDIA continue this historic run it's really been on.
Well, AI is here to stay and in different ways. So NVIDIA is the leader in that. So that's really exciting. And folks have done well, although be careful out there. The stock that's up 200% this year already, that run's going to end, right? And when it gets
exactly,
be careful out there. And we'll see, Chris, all of the stuff about China. Now, this is an example of what happens to an economy when you spend a lot of time putting your finger on the scale and picking winners and losers and not letting the market pick winners and losers. And that's what the Chinese government likes to do. They do like the benefits of capitalism, but they don't like the freedom of capitalism because they want to control everything. So America is still the most capitalistic liberty and freedom country in the world. And that's why our economy is acting better. And so far, if we keep it that way, hopefully it stays that way. Right.
Yep.
We're moving more and more socialist, and that's for a lot of capitalists a scary thing. But we'll see how it all plays out. Chris, big news: the Roaring Kitty is back. Those of you who remember from January and the early first two quarters of 2021, GameStop and all the other meme stocks, AMC and some of the others were running big time off a group of traders that were all buying the stock with reckless abandon, led by this one young gentleman who was up in his basement in somewhere in Massachusetts, I believe. And there was a movie called Dumb Money he was featured in, Roaring Kitty. And he would get on there and do videos and get everybody all jazzed up about these meme stocks, to the point that they were so overpriced that hedge funds were betting against them, and they beat the hedge funds. And so if you haven't seen the movie Dumb Money, pull that out, have a look at it. It's really interesting. So sometimes the little guys win, and all they did was follow the rules. They even had an inquiry in Congress, and they dismissed them without any charges. They followed the rules. They did the right thing. And unfortunately, they bankrupted at least one very large $3 and $4 billion hedge fund. So sometimes the good guys win. We'll see. That happened this past week. And then that's really pretty much it. The whole Chinese story is really, an interesting one to see how they can recover and if their political system can handle their command and control system. So anyway, we'll see. I think that's all we have for today, Chris.
Yeah, I think that covers it for the last day of May right now.
Well, thanks everybody. We start June tomorrow. Watch for the Leadership Matrix, which is on the FourStar website. We have a whole bunch of blogging sites on there. And also watch for some of the other blogging sites on there. There's a lot of interesting articles that we send out about things that are going on in the economy. So you can join that blogging site just by going on there, and then it'll ask for your email, and then you get all of our updates. And then, of course, you're getting these updates from the FourStar podcast. We're coming out with a couple of really interesting interviews with a hedge fund leader, commodities fund leader as well. So you'll see those very shortly as well. And then Chris and I will be back within about 2 weeks, give another update on the economy and the market, and we'll see where we are on progress. Are we going to see interest rates start to go down, or is inflation going to come roaring back in the numbers in May and into June? And then we'll have to see interest rates go up if that was the case. So we'll see where it all shakes out. But it's certainly interesting to watch, and hopefully the economy survives.
Yeah, sounds good, Brian. Take care, everyone out there.
Hey, thanks everybody for being with us. We'll be back again with another episode. Thanks for being with us on today's Market Explained, a FourStar podcast. Bye-bye for now, everyone. Thank you.